What's up, everybody? Hope you've had a great week. This is your weekly update in the economy and with regard to the markets. So this week has been a busy week, but it's been really a noisy week, right? It's been a very noisy week. You've got things in the media. We're talking about the debt ceiling. We got Jerome Powell talking today. We got other Fed members have been talking throughout the week, most of which they don't even really agree with their own monetary policy. We'll get to that in a minute. You've got banks that are struggling to raise capital. People are kind of, whispering, bank failures more. You got SVP and Signature Bank that's already failed. Now listen, let me just stop there for a minute. Banks are safe. Those banks that failed, 89% of their deposits were uninsured deposits. On average, most banks are like below 50% in that ratio. All right, most banks are perfectly fine. Some of the smaller community banks, certainly with the rise in the Fed funds, affect their cost of funds, which can affect some of them to have to raise enough adequate capital or maintain enough adequate capital to cover their balance sheet. So some banks are really having a hard time making money, and so I would say your bank is safe. But if you want to look at it as an investment, maybe it would be a little riskier to invest in banks right now as far as buying a stock. But otherwise, banks are safe. Don't worry about having to pull your money out and all that kind of stuff. Banks are safe across the board, relatively speaking, especially the more established ones. So don't worry about that. We're not going for another market crash. The banks aren't failing or anything like that. Now let's talk about the Feds though, because really they are in the center of all of these problems. I mean, the reality is, if you listen to what a lot of the members are saying, they're saying two different things, sometimes three different things. Some of them are not sure if they should raise rates more. And to me, it's like a toddler. I mean, it's unbelievable how they're acting. So if you have a headache, you're going to take some Tylenol, right? Maybe some Advil. All right, but you're going to give it time, right? You're going to give it time to settle and clear your headache. But the Feds don't seem to understand what they do in their monetary policy affects inflation. Now keep that in mind, because that's the key. The Fed fund rate, the key rate, is not a mortgage rate. It doesn't directly affect mortgage rates. The markets, in particular the mortgage-backed securities and those that trade those bonds, they are trying to figure out if the monetary policy is going to affect inflation down the road, typically 6, 7, 8, 9 months down the road. There's a lag. So when they raise rates or lower rates, whatever they're doing is going to take effect in the economy. We're going to start seeing that effect usually at least 6 months down the road. But what they're doing is, in using that Tylenol analogy, hey, I've got a headache. I'm going to pop 2 Tylenol. And 5 minutes later, I still have a headache. I'm going to pop 2 more Tylenol. 30 seconds later, I still have a headache. I'm going to pop 2 more Tylenol. I'm going to keep doing this until I die. I mean, that's essentially what they're doing. I mean, they're killing the economy, and they're hurting banks. They're hurting you and I as consumers. And the reality is they're not giving it time to marinate what they're doing. So we are starting to see some indication that inflation is coming down, but we've got to have patience. They have to have patience. And we're going to start seeing that. Definitely, we've already seen it. We talked about it last week in the CPI report that we saw that inflation is on its way down. Next month, we're going to see that continue to come down. And so as we see these numbers, if we have patience throughout the rest of this summer, rates will follow. Inflation will follow. And maybe, just maybe, Jerome Powell and his friends will start seeing that what they've done is actually helping if they don't kill it before it actually, takes the benefit that we all hope it will. So be patient. Rates are up a little bit, but listen, in the long haul, we have opportunities, to make sure that our clients understand there are still temporary rate buy downs available out there. There's all sorts of programs out there we talked about over the last few weeks. So talk to your mortgage professional about all the things that are available, short term, long term, so we can protect our buyers, protect our sellers, as the inventory is still at a low point. So demand is still there. So we just have to be patient, and we're going to see better rates ahead. But you guys have a great weekend. Give us a call if we can help in any way.